How you doing this morning?
Doing great, Michael. Glad to be here and good to see you.
Nice to see you as well. Again, thank you so much for doing this. The first thing we're going to do is we're gonna take out our crystal balls. We're going to put it on the table, and we're going to try to make predictions about next summer. Your crystal ball is just as broken as mine, but hey, it's sometimes fun to think about next year and where things might be. You ready?
Yeah, my prediction is it's going to be hot.
It's I'll take that bet. I think you're right. So let me share this with you because, again, I shared this on my channel. I walked through my logic with everyone. Oh, am I not sharing? There it is. Okay, good. All right, here we go. You can see it now, yes?
Yep, I got it.
All right, cool. Let me make it just a touch bigger. And we're going to go through, I think it's 8 questions. First off, this is obviously not financial advice. It's just 100% guessing. But I think it at least when I went through this, Greg, it kind of oriented to me what investing I'm going to do now, right? With kind of what expectations I have for next year. So let's see. So here you go. Question number 1. Obviously, I'm a real estate oriented channel. And one of the things we've been suffering through, Greg, for the last 18 months is available inventory, right? Available inventory at the last recording was 1.32 million. A normal market or average market's about 3 million. So by next year, 12 months from now, will we still be A, under 2 million, B, somewhere between 2 and 3 million, or do you think a bunch of supplies coming in will be over 3 million? Again, 12 months from today.
There's a lot of variables that can affect that, but, I say we'll probably be between 2 and 3 million. I think inventory levels are going to pick up a little bit, but we're going to still stay below where we need to be from a normal supply demand standpoint.
Yeah, I think that's reasonable. I think that's exactly where I was. So, okay, that's step 1. You'll see a lot of these tie together as you've kind of alluded to. Next up, interest rates. You're on record. I think you say this all blows up at 5%. I think if I remember correctly, maybe it was 4. I think it was 5. Interest rates today are just over 3. So where do you think rates will be in a year? Will they still be under 4? Will they be below or between 4 and 5? Or do you think they might be over 5%?
30-year fixed rate.
Correct.
I think we're still going to be under 4% in a year from now.
Okay.
Based on where we stand in terms of economic activity and things like that, I just don't see them being able to raise it anytime soon.
Yeah, that's exactly where I was. I actually, in my video, I think I said, if I would have, instead of next summer, if I would have said like next December, I might have said just over 4. Rates, I went back 50 years. Rates don't move that fast. Because again, a move from 3 to 4 is 25%, right? It's 1%, but it's a 33% move, right? 1% move on a base of 3. So yeah, I
could see us getting to 4, but 4 is for me. 4 is the magic number.
4 is the magic number.
4%. I think that's where you're going to see serious problems. If you get to 5, it's lights out. But I think 4% is the number mentally for a lot of people. As long as you're in the 3s, everything remains healthy. You get out of 3% range into 4, and that's going to trigger a lot of pushback mentally from a lot of people.
Yeah, even though, right, old guys like you and I know that 4% is still really cheap money, but we've had 3% money and 2% money. So it just feels, there'll be a lot of, so 4% is the magic number. I was wrong. Okay. All right. That's number 2. Here's number 3. So there's a lot of talk by what I call the handout administration about creating a first-time home buyer, some kind of credit, whether it's a tax credit, down payment assistance, some new program. So basically, there's kind of a 2-part question. One, do you think that gets created between now and next summer? If the answer is no, kind of over. If the answer is yes, do you think it has a cap at 15K? Or do you think the cap might be something in excess of 15 grand?
I have no idea. That's the one thing they're not really talking about right now in the administration. I think they have a lot of other things they're focused on. So I really have no idea what to expect there. So I'm gonna have to say no. I wouldn't expect to see anything on the table for housing because everybody knows the market's overbaked right now. And I think the biggest talk right now on the table is how the Fed has created a serious problem in the housing market. So if they come out and try to provide any more incentive, I think that's going to create even a bigger problem. So I think we need to see the dust settle a little bit before they try to push any more programs to encourage house buying.
Yeah, this is one where you and I disagree. Well, first off, we agree logically. I mean, your logic is solid, and the last thing you need is more demand today, right? All right, we have a supply problem, not a demand. So creating more artificial demand or incentive demand in the short term is a bad idea. So the answer should be no, but I actually went with C. I'm like, yeah, they're going to do it and it's going to be big, right? I think the cap could easily be 25 grand. Again, it's a cap. Not everybody gets 25 grand, but that's kind of where my head's at. But yeah, it's interesting. Again, both of us have no idea.
No,
Higher,
there's no talk of anything right now, so I really don't know.
yeah, I think it's baked in the cake. They're just not telling us, but we shall see, right? This is just all opinions and speculation and guesses. How about higher taxes, right? This is specifically higher taxes on capital gains, kind of the same deal. One answer could be no when you're done. If the answer is yes, do they kind of capitulate, meet somewhere in the middle? I picked 30%. Or do you think they just raise it to ordinary income as they've been talking about going forward?
Yeah. So again, I mean, they're not even really talking about a whole lot of that right now, but I would say definitely that they're going to attack capital gains, especially for higher income earners.
Mm-hmm.
If they can segregate it that way of over 30%, they're definitely going to be going after corporations, capital gains.
Yeah.
And I mean, there has been talk of retroactively taxing capital gains. So we'll
there
see
has. Yeah.
And unrealized gains. I mean, that's another big part of the conversation. And
yeah.
On top of all that, there's information out there about how much, more information from the banks will help the IRS collect a lot of money. So may not be long before they're going to reconcile your taxes with your bank accounts.
Yeah. So I went yes over 30%. I think this is a very slippery slope. I've seen several articles talking about unrealized gains for billionaires specifically. Man, they go after unrealized gains. That's a step into some interesting areas.
Imagine what that would do to real estate. Just think anybody in the last year whose property's gone up 30% and having to pay tax on that.
Yeah. No, thank you. I don't want to think about that.
Capital gains tax, not real estate taxes, because that's going to go up too.
Yeah, that's scary thoughts. All right. How about rent? Obviously, this is rent specifically for single family homes. We have seen rent increases in double digits the last year. It seems to be popping off everywhere across the country. Do you think that continues? No, again, is an acceptable answer. Yes, but under 10% or yes and over 10%. Single family.
I think
homes.
It's going to be local, but I think in some areas, yes, it's still going to be over 10% rent growth in a year. Some areas it may decline. So, that's hyper local, but yeah, in your high demand markets, I think you're going to continue to see pressure on rents, especially if we get another surge of the COVID variant this fall up in the Northeast, like they're talking about. They're saying our surge in the Northeast. I'm not Northeast, but Virginia North. We haven't really seen the big surge like they've seen in the South. I'm not sure where you stand on the West Coast right now. I guess some areas, it just all depends. So I think you're going to see demand again from people leaving the Northeast when that starts to happen.
Gotcha. Okay. Yeah. Rent growth. Yeah. For me, this one all ties together, right? Rent growth, available homes, interest, cheap money. It's like, I'm going to go get as much cheap money as I can and buy houses. Cause I think you're right. I think rent growth, again, hyper local, but yeah, space is good. And again, I think we talked last week, demand moves faster than supply, right? The want for a house is much easier than trying to have a builder build a new house. It's just demand can move so much faster.
Positive net migration. So if you go to U-Haul, they have some great statistics on moving, people moving in the areas they're moving to. So if you just follow that, where are people moving to? That's where your rents are going to go up because there's going to be competition.
Yeah, I actually did that. I talked about, I think last week, memory serves, the top 3 states. Nashville was number 1. Florida was number 2. And I think Texas was number 3. All states.
Well, Nashville's not a state, but
I'm sorry, Tennessee. You're right. Sorry, you're right. Good catch.
It might be if they keep moving in, because that's the fastest growing city in Tennessee, I think.
Yeah, you're right. It was Tennessee, but the city was Nashville. Thank you very much. Good catch. So now let's talk about inflation. Obviously, the Fed's favorite inflation gauge is PCE, personal consumption expenditures. Last reading was 4.2. They're targeting over 2. Will it still be A, over 2%? Will it, yes, be over 2, but under 3? Yes, it will be over 3%. And again, this is
definitely over 3%.
Oh, wow. A year of this. I agree with you. The scariest thing, Greg, is I actually peeled apart the PCE reading for July, and comparable rent, I think they call it, housing comparable rent was 1.7%. I'm like, dude, this is showing nothing yet. That's got to be up 8, 9, 10%. And then we have Social Security COLA increase of 6%. This PCE gauge is about to explode, I think. So I agree, 3%. Just because everybody talks about stocks, I admittedly have $0 in stocks. I've had $0 in stocks for about a decade. So my opinion doesn't matter on this, but everybody talks stocks. So the S&P 500, when I recorded this, was just over 4,500. Where do you see it in a year? Do you see it over 4,500, under 4,500? And then kind of a part two question. Do you think there was ever a 25% move either way inside of 12 months?
Yeah, I think we're going to see, a 25% or more correction across the board for all markets.
Okay.
Probably this year,
Okay.
especially depending on what the Fed does and continues to do. Where will it be next year? I have no idea. You have to expect it to be either at where it's at, coming back off of a big correction, or higher based on how the Fed responds to that.
Okay.
So, I mean, I really have no clue, but what I do know is we are due for a correction. I mean, we're getting record highs every single day in every market.
Yeah.
So, every market, real estate, financial markets, the whole 9 yards. So, there has to be something at some point, but it's all up to the Fed. Right now, it's still risk on. They're still printing away. They're still, interest rates are still low. So until the Fed makes a move, it's going to continue unless something else happens that nobody knows about or isn't talking about right now.
Yeah, I saw a very interesting statistic. I'll be close. I may not be dead on, but I think the S&P 500 has had 54 record closing days in 2021. And I think there's only been like 123 trading days or something. So it's like 40% of the closing days have been records. That's not normal.
Well, here's an interesting statistic as well. The biggest stock market crashes in the history of the world have all been in October.
Oh, there we go. That's fun to think about.
Going all the way back to, the Great Depression, and then, there was Black Monday or whatever it was. And then
Black Monday,
financial crisis of 0809. They all started in October.
Oh, joys. Right around the corner. All right. I think this is the last question. So again, I'm a real estate channel oriented. We had a last print of the median home, again, nationally speaking, was 369. Where do you think we are in a year? Do you think we're under 369, somewhere between 369 and 400? Or do you think we're booming at something over 400?
I think you're 369 to 4 if all things remain equal and interest rates do not get over 4%. If rates cross 4%, you're going to be under 369. Values are going to drop fast.
Okay. Yeah, I think you're right. I think what I'm telling folks is we saw a lot of the 2021 appreciation early. It was like front loaded. We should be plateauing or definitely lowering the curve, if you will.
Yeah, prices have definitely leveled off. Buyers are pushing back. Builders are starting to catch up a little bit potentially. So, things should remain stable if rates remain low. But as rates go up, prices come down. That's just how it works.
Yeah. This is all interesting. Again, this is entirely prediction, folks. If you're watching this, I think it was 8 questions. Take out a piece of paper and let us know what you think. You can always leave your comments below. Let us know question 1, 2, 3, 4. I did this because I like kind of piecing together the puzzle, right? Real estate to me is a puzzle. Interest rates, inventory, first-time home buyers, all of these things I think relate together. And if you can understand what your opinion is, that's what I use to make my investing decisions. And right now, I'm buying as many single-family homes as I can with cheap debt because I think rents are going up. I think rates will go up in the future, and I want to lock in some 30-year money. So that's what I'm thinking.
Well, that's the one thing. So a lot of it is dubious speculation because there's so many variables, and it all hinges on what the Fed does and where we are from the pandemic standpoint, all of that. But the one thing that you can pretty much count on is rates can't get much lower than they are right now. Exactly. So take advantage of that because they've got nowhere to go but up. We're going to face inflation. The only way to fight that is to raise interest rates.
Yep.
The Fed's going to have to pull the foot off the gas on mortgage-backed securities, buying those. So that's going to cool off and increase rates in the housing market. That's what's going to drive mortgage rates up.
Yep.
Those types of things. So rates. That's the one thing I think we can predict is that rates probably aren't going to be much lower, if at all, a year from now.
Yeah, I totally agree with that. That's why I think, and again, what we talked earlier, higher taxes. That's another reason I'm being very aggressive these next 3 or 4 months because I may be able to find some motivated sellers that want to sell this year versus next year. and we can do some creative things. So Greg, thank you for doing this. How can people follow you and be part of your world?
GregDickerson.com. All my info's there, YouTube podcast, and go check it out, GregDickerson.com.
Yeah, do yourself a favor, folks. Follow Greg Dickerson on YouTube. He puts out amazing content. He is far more versatile and covers a lot of things that I do not cover. So follow his stuff. Thanks, Greg.